Welcome to the Deep Dive. We're here to help you cut through the complexity of corporate financial reports and get right to the important stuff. Today, we're taking a deep dive into Bank of India. Their latest results are out Q1 for the fiscal year 26. So our mission, as always, is to dig into the sources, the press release, the investor presentation, the auditor reports, and pull out what really matters. What are the key facts? Any surprises? By the end, you should have a much clearer picture of how Bank of India is doing, what's driving those numbers, and why it might matter to you. The big question maybe is, are these impressive headlines the full story? Or are there still some challenges lurking? Okay, let's unpack this. So kicking things off, what were the main figures that really jumped out at you from this quarter?
Well, the first thing you notice is definitely the net profit. For Q1 FY26, it shot up 32% compared to last year. That's 2,252 crores.
32%, wow. Yeah. And it wasn't just that. Operating profit also grew nicely, 9% year over year, hitting 4,009 crores. And what's interesting, I think, is how this profit growth connects to their overall business expansion. It's not just, cutting corners. The bank's total global business actually crossed the 15 lakh crore mark. That's a big milestone.
Right, so growth across the board, not just profit. And that expansion showed up on the balance sheet, too, I saw. Talk about the advances and deposits.
Exactly. So global advances, that their loans basically grew 12.02% year over year. Domestically, it was up a solid 11.24%. But the overseas advances, they grew even faster, 16.34%.
Interesting split.
Yeah. And deposits kept pace too, up 9.07% globally year over year and slightly stronger domestically at 9.62%. It suggests, good demand for their loans and people trusting them with their money.
Okay, so business is growing, profits are up. How efficient are they being with all this? What do the key profitability ratios tell us?
Good question. If we look at profitability, the return on assets, ROA, is at 0.82%. And maybe more importantly, return on equity, ROE, stands at 13.55% for the quarter.
And ROE, just to remind folks, is how well they use shareholder money to generate profit.
Precisely. So 13.55% is pretty healthy. Combine that with their core lending profitability, the net interest margin, or NIM. Globally, that NIM was 2.55%, domestically 2.22%. It shows the core business is making decent money, even with changing interest rates. You can see the spread too. Yield on advances globally was 8.01%, while their cost of deposits was 4.85%.
Okay, that makes sense. But, while the profits are growing, I did notice operating expenses also increased by about 8.29%, and the cost-to-income ratio is sitting at 51.31%. How should we read that? Is that expense growth worrying, or is it just investment?
That's a sharp observation. Yeah, expenses are up 8.29%. That cost-to-income ratio, 51.31%, basically means for every rupee they earn, just over 51 pays goes to running the bank. Now, a rise in expenses isn't always bad. It could be strategic investments, technology, maybe new branches, talent, things that cost now but pay off later. The key thing is whether income is growing faster than costs. And this quarter, it seems it did, which kept that ratio sort of stable. But yeah, it's something to watch.
Definitely. Okay, let's shift focus to something critical for any bank asset quality. This feels like where Bank of India has made some really big strides. Gross NPAs improved by 170 basis points year on year, down to 2.92%. And net NPAs improved too by 24 basis points, down to 0.75%. That seems significant.
Oh, it's absolutely significant. If you connect this to the broader picture, these NPA reductions show they're really getting serious about recovery and making adequate provisions. They're cleaning house.
Right.
Their provision coverage ratio, the PCR, is up 83 basis points to 92.94%. That's very high. It means they've put aside funds to cover almost 93% of their identified bad loans. That's prudent.
Okay, so they're well covered.
Yes. And their credit costs, essentially, the cost of bad loans hitting the P&L improved too, down 17 basis points to 0.68%. Better risk management, basically. It's a real achievement.
So the overall picture is improving. But let's get into the flow, the mechanics of it. What about new bad loans versus recoveries? I saw fresh slippage in Q1 was 2,008 crores. They recovered 1,226 crores in cash, but then they also wrote off 2,459 crores. What story do those numbers tell?
Yeah, this is where you see the active management. The slippage, 2,080 crores, that's the new pipeline of loans turning bad. The cash recovery, 2,226 crores, is them clawing money back. But that write-off figure, 2,459 crores, is quite large. It suggests they're being aggressive about removing old, stubborn, bad loans from the books entirely.
So taking the hit now to clean up.
Exactly. It hurts short-term profit when you write off, but it cleans the balance sheet for the future. It's like finally clearing out the attic. Necessary, but takes effort.
And if we look at where these bad loans, both the existing stock and the new slippages, are coming from, any particular sector standing out?
Yes, definitely. If you look at the total gross NPAs, agriculture makes up a big chunk, 46%. And MSME, the small and medium businesses, contribute 33%.
Hmm.
So those two are the main sources of the existing problem loans. Now, for the fresh slippages this quarter, agriculture led again with 37%, and MSME was right behind at 35%. Retail saw about 20% of new slippages, and corporate loans only contributed 6%.
So the big corporate book seems relatively stable this quarter in terms of new problems.
That's what it looks like, yeah.
Yeah.
The newer issues seem concentrated in agri and MSME again.
Yeah, okay. Now, what about assets that aren't yet NPAs but are showing signs of stress? I saw the SMA2 numbers, particularly for larger accounts over 5 core. That jumped quite dramatically, didn't it? From about 1,042 crores a year ago to nearly 4,500 crores now. What's going on there?
Yeah, that SMA2 increase for larger accounts from 1,042 cores to 4,498 cores, that definitely catches the eye. It's a significant jump.
And SMA2 means loans 6190 days overdue, so close to becoming NPAs.
Exactly. It's an early warning signal. It tells us that while they've done a great job cleaning up past NPAs, the pressure isn't entirely off. There are newer stresses emerging, potentially in larger ticket loans.
So something to keep a very close eye on in the next few quarters.
Absolutely. It suggests the fight for asset quality is ongoing. However, they are taking steps. They mentioned holding 100% provision for certain high-risk NCLT accounts totaling over 3,000 crores. And they're using restructuring frameworks for stressed retail and MSME loans too. So they're aware and acting. But that SMA2 figure is a flag.
Right. And briefly on risks, they reported 35 fraud cases too in the quarter. Involvement of about 11,160 crores, with roughly 566 crores outstanding. But the positive note there is they hold 100% provision against that outstanding amount.
Yes, that provisioning is key. It means the financial impact of those specific frauds is already accounted for.
Okay, so they're managing risks, cleaning up the books, but where is the actual growth coming from? Let's talk about the loan book expansion. Which segments are they pushing?
This really shows their strategic direction. Retail loans grew strongly, up 19.62% year over year. MSME loans were also up significantly, 17.36%, and agriculture loans grew 12.21%.
So a clear focus on RAM, retail, agriculture, MSME.
Absolutely. It looks like a deliberate strategy to grow in these more granular, often higher-yielding segments rather than just relying on big corporate loans.
Makes sense. And drilling down into that retail growth, any specific products doing particularly well?
Yes. Within retail, home loans grew 14%. Vehicle loans were up a strong 21.64%, and personal loans grew even faster at 21.73%.
Okay, so broad-based retail strength.
Very much so. And it means the share of these RAM segments in their total domestic loans is now over 58%. That provides good diversification.
And they seem well capitalized for this growth. I saw the capital adequacy ratio, CIRR, was comfortable.
Very comfortable. CIRR is at 17.39%, well above regulatory requirements. Plus, they've got approval for a 5,000 crore capital raising plan for this fiscal year, using Tier I and Tier 2 bonds if needed. So they have the capital cushion to support this growth strategy.
Good to know. Let's pivot now to their future-facing strategies. Digital transformation seems huge for them. Their BOI Mobile Omni Neobank app apparently has over 1 crore customers now. And digital transactions are up to, 95.4% share? That's massive for a public sector bank.
It really is massive. It shows they're not just talking about digital, they're executing. It reflects a big strategic shift towards modernization and, frankly, customer demand.
Right.
And it's not just the main app. They mentioned WhatsApp banking having over 3 lakh active users for 22 different services.
Yeah.
They've got UPI on credit cards now, an e-platform for 29 products. Internally, too, they're using tech. Project Star ADIA for data analytics, intelligent process automation saving 22,000 man-hours by automating processes.
So it's efficiency gains as well as customer convenience.
Exactly. It's about becoming leaner, faster, and more data-driven. It's pretty impressive for an institution of their size and history.
And alongside digital, they seem keen on ESG, environmental, social governance. They launched a green deposit scheme, Star Hardy Jama Yojana, raised 400 crores in Q1, plus over 5,000 crores exposure to renewable energy. How seriously should we take this ESG focus?
I think quite seriously. ESG is becoming table stakes for banks globally for reputation, risk management, and attracting investment. That green deposit scheme directly links their funding to environmental projects. That's tangible. And the social side is strong too. Their CSR budget for FY26 is up 87% YoY. They've reached millions through financial literacy centers, PMJDY accounts for inclusion, supporting farmers with T-sign credit cards.
And the focus on women entrepreneurs stood out too.
Yes, over 4 lakh women assisted, and 35% of their MEDRA loan beneficiaries are women. And it paints a picture of a bank trying to be, socially responsible and inclusive, not just profitable.
Okay, let's quickly touch on their physical presence in people. Still a huge network, over 5,300 domestic branches, 22 overseas, nearly 8,000 ATMs. How does that fit with the digital push?
It's a hybrid model, clearly. They need the physical network for reach, especially in certain areas, but they're optimizing within it. Look at the productivity numbers. Business per employee is nearly 3,000 lakhs. Profit per employee over 17 lakhs. That suggests efficiency gains, perhaps driven by those digital tools freeing up staff time.
And they mentioned initiatives like Project Starlight for people management.
Yeah, things like leadership podcasts, Star Samad. It shows they're investing in their workforce too, which is crucial for executing all these strategies.
Right. Now let's dig into a couple of nuances from the reports. There was an exceptional item mentioned in the consolidated results related to merging some regional rural banks, RRBs. Can you clarify what that actually means for their bottom line?
Sure, this is mostly an accounting adjustment. The government has been merging some RRBs. Bank of India held capital in a couple of these, Vidarbha Konkan Gramin Bank and RER Bank. As part of the merger process, some of the capital was effectively redeemed or adjusted. So you see these figures, 450 crores from one or 206 crores from another, flowing through the P&L.
So it's not really about their core operations this quarter.
Not directly, no. It's a one-off impact from this broader consolidation trend in the RRB space. It affects the reported consolidated profit for the period, but it's marked as exceptional because it's not part of the regular business.
Okay, that's clear. And what about the auditors? They gave an unmodified opinion, which sounds good, but they did note that many branches and some overseas units were audited by others or weren't reviewed for the quarter. How significant is that note alongside the clean opinion?
An unmodified opinion is the best outcome you can get from an audit. It means the auditors believe the financial statements give a true and fair view following all the rules.
Even with parts audited by others.
Yes. That note about distributed audits is mainly procedural transparency. For a bank this size, it's common practice to have different auditors handle different parts. The main statutory central auditors rely on that work. The fact they still issued an unmodified opinion means they're satisfied with the overall process and the reliability of the final numbers. It provides strong assurance.
Got it. And finally, the bank certified no issues with how they used raised capital funds, and they're meeting all their debt obligations. Their total debt stands around 1.27 lakh crores. Those certifications matter for confidence, right?
Absolutely. They're standard but crucial disclosures. They confirm good financial housekeeping, managing capital properly, sticking to loan agreements. It builds trust with investors and lenders.
Okay, so let's try and sum this up. It feels like Bank of India had a genuinely strong quarter. Good profit growth, significant cleanup of bad loans, and clear progress on digital and strategic growth areas like RAM.
I'd agree. The Q1 FY26 results paint a picture of a bank that's firing on several cylinders. They're managing the core lending business well, being quite proactive on asset quality, and making smart investments in technology and ESG or inclusive initiatives. It feels like a comprehensive turnaround story gaining momentum.
So, thinking about the broader landscape, considering Bank of India's performance this quarter, what lessons might other public sector banks draw from their focus, specifically on cleaning up assets, pushing digital adoption hard, and driving that inclusive growth? Something for you to think about. How sustainable is this path for Bank of India, and what does it signal for the rest of the sector in this constantly changing economic environment?